Meanwhile, Starbucks is hitting the reset button. The coffee giant has unveiled a plan to close stores, cut jobs and reimagine its business as it struggles with falling sales and changing consumer habits. It's also one of the many multinational companies consumers are being urged to boycott due to its business in Israel amid the war on Gaza. But can a leaner, more focused Starbucks reignite growth, or is this just the start of a deeper shakeup? Now, Starbucks is embarking on a billion-dollar restructuring plan to revive growth in its largest market. The coffee giant will shutter about 500 stores in North America and lays off 900 non-retail staff as part of its Back to Starbucks transformation. At the same time, store sales have fallen for 6 straight quarters, hit by rising competition, a massive boycott and cost-conscious consumers. Around $850 million of restructuring changes and $150 million in separation costs will weigh on profits this fiscal year. But the coffee giant says the plan will allow it to prioritize customer-centric investments and remodel cafes into so-called third places where customers linger. With nearly 18,300 locations still expected by year-end, the company plans to resume growth in 2026. CEO Brian Nichols says the shake-up is about building a stronger, more resilient Starbucks. The company is also investing $500 million in its workforce under the Green Apron Service initiative, which focuses on the in-store experience rather than mobile and pickup services. But shares are down 8% this year, and analysts say the closures are more aggressive than expected, underscoring how far Starbucks must go to win back customers. Let's cross now to Joel Saldana. He's a business consultant joining us from Dubai. It's good to have you on the program with us. Now, firstly, is the ongoing global boycott of Starbucks having a deeper impact on the brand and sales than it's publicly admitting?
Quite difficult to quantify the full impact of any boycott, especially when multiple factors are involved. It could be competition, pricing, or even consumer behavior, which are all at play at the same time. Starbucks has acknowledged 6 consecutive quarters, as you just mentioned, of declining same-store sales, which should raise eyebrows in the management and the board of directors to see what actions could be taken. But attributing all that solely to a boycott could oversimplify the issue and probably narrow down the core consensus on what needs to be done. The brand remains resilient. We all know that it's been a very long, around for a very long time, and it has had its phases during the course of its journey. This restructuring appears to be a proactive step to address broader challenges.
So how significant is this billion-dollar restructuring for Starbucks' future growth?
I would say this is a long time coming, considering the various factors that have been happening in the last couple of years. It's a very pivotal investment that should have been done a while ago, but it's never late. It's better late than never. Starbucks is signaling a long-term commitment to revitalizing its core operations. That's the core objective of what it's looking at, especially in the key markets of North America and Canada. While $1 billion US is substantial in terms of the restructuring project, the focus is on refurbishing its stores and enhancing customer experience, suggesting a very strategic turnaround, not just through cost cutting. It's about recalibrating the brand to meet evolving customer expectations and positioning for sustainable growth beyond 2025. And I surely hope they will meet their objective of turning things around in 2026.
And will this investment in customer experience reverse 6 quarters of declining sales?
That is something that we cannot really guarantee at this stage. But I would say Starbucks has really taken a step in the right direction, which probably should have been thought of some time ago. But as I said earlier, better late than never. Starbucks is betting on the power of human connection, which has been its flagship in terms of the experience that you have with their coffee or their meeting points. Adding seating, redesigning stores, investing in a better and a more elaborate frontline staff. Early feedback has also suggested that customers are staying longer and engaging more in these kind of environs. While it may not yield immediate financial turnaround, it lays the groundwork for rebuilding loyalty and driving repeat visits.
And what does this move tell us about broader trends in retail and consumer behavior, not just within Starbucks?
It reflects a shift back to the experiential retail. We all know what happened post-COVID or during COVID, where people decided to go online, have everything delivered through automated mediums without the real touch of human contact. Consumers are craving more than just convenience. They want atmosphere, they want personalization, and they want community. Starbucks' decision to phase out mobile-only stores and reinvest in physical cafes aligns with a broader trend. Brands are reimagining their spaces to foster deeper engagement, not just their transactions.
Joel Saldana in Dubai, thank you very much for your insights.
Great. Thank you.